Hi there, I'm Tyler Ballhorn, and this is the Stockscores Market Minutes for March 18th, 2013. This week's topic, trading speed bumps and cliffs. I'll show you how to tell the difference between a pullback and a trend reversal. Reminder to subscribe to my weekly newsletter. It's free at stockscores.com/newsletters.asp. Another reminder is that I will be back on the road for the Stockscores Canadian Active Trader Expo Tour. You can see the dates there on screen. Calgary, April 6th and 9th, Edmonton, Vancouver, Victoria, Toronto, and Montreal, all this spring. Each 2-hour presentation will teach you valuable lessons about trading the stock market, and we'll also go through some of the stocks that you have an interest in. I'll show you how to analyze them and use my method of analysis to find the hot stocks of tomorrow. These presentations are free. As I said, they are 2 hours long, roughly, and you can see more information at stockscores.com/skate, SCATE, at the bottom there, and register for one of these events and also learn a little bit more about what we will be covering at these events. All right, let's get into the topic of the week, trading speed bumps and cliffs. I make a little bit of a joke about this, but you know, in upward trending markets like we have in the US right now, there are inevitably going to be some speed bumps in that trend, and these speed bumps are actually healthy. They recharge buyer interest, and they also give the bulls an opportunity to pick up some bargains in strong stocks. Speed bumps essentially put strong stocks on sale, but it's important to be able to differentiate between the speed bump and those cliffs where the market is reversing and starting a sharp downward move. We obviously want to avoid those sorts of things. Well, the difference between them can be defined with trend line breaks and falling tops, and I'll show you that with a couple of examples in just a moment. We want to buy pullbacks to the trend when those pullbacks come from new highs in the trend. On the other hand, if we see a break of the trend from a falling top, well, those are times to run for cover. Let's take a look at some charts and I'll show you what I mean. Here is the stock that's done pretty well over the last 5 or 6 months. It is AmerisourceBergen, ABC, on the New York Stock Exchange. And I've drawn a few blue boxes there, which were pullbacks in a really strong, nice linear upward trend. We'll notice that each pullback came after the market for this stock had hit a new high. And I've drawn those new highs with those horizontal red lines, the short ones. So for example, in mid-December, the stock hit $44 and then it pulled back for a week or two. The next upward wave took it to 46 and then it pulled back for a week. It then went to 47 and so on. But you'll notice that each pullback came after the stock had hit a new high, and the long-term upward trend line, which I have drawn in green, had not been broken. And we'll see on the overall market that this is also the case, where we're getting pullbacks from new highs, but we are not getting pullbacks from falling tops or breaks of the upward trend line. Now here's another example of a stock that did quite well from September until mid-January. This is the chart of Tech Resources. But notice that in that breakdown in early February, it broke the upward trend line, which I've drawn in green. But notice also that there was a falling top before that upward trend line was broken. Now think about what that falling top means. The market rallies, it pulls back, and then the buyers try to rally the stock higher again, but this time they're unable to push the stock to a new high. That is a sign that the buyers are losing their enthusiasm. Well, ultimately we got that breakdown of the upward trend line, and that started that strong downward move from the high 30s to where it is now, the high 20s. That is an example of a cliff where the stock broke the upward trend line from a falling top versus a speed bump where the stock simply made pullbacks in that long-term upward trend. All right, now let's move on to the chart of the S&P 500, because you will see that we are right now in a speed bump. The market hit a new high last week. We've pulled back for 3 days, but we have not broken the upward trend line, and we have not broken down from a falling top. So at this point, this market remains a bullish market. Now, it doesn't mean that the market on its next attempt at a rally can't make a falling top. That is certainly possible. But for now, we should remain bullish simply because that upward trend line is intact and there is no falling top. The TSX is in a consolidation pattern as two different groups of stocks in the Canadian market really battle it out. On one hand, you've got the banking stocks, the telecommunication stocks, the rails, which have done very well in the last number of months. On the other hand, you have the precious metals, the miners, the material stocks, the energy stocks, which have done pretty poorly. And the result is you've got this sideways moving market. And it's a bit deceptive because there are some groups in this market that are doing well, and then there's some groups in this market which are doing really awful. Well, what's encouraging is that the bottoms are rising on this chart. And I get a sense that some of those underperforming sectors may start to play catch up, particularly the energy sector, which in the last 2 weeks has made a break higher, likely because there's starting to be some optimism about maybe the Canadian energy producers getting a little bit better transportation into the US market with the Keystone Pipeline. Here is a chart of the 20-year Treasury bond ETF. It is in a downward sloping trend. It's had a little bit of a rally in the last week or so as some uncertainty arises over what's going on in Europe, but it still hasn't broken that downward sloping channel. So we need to remain bearish on treasuries, US treasuries, but that is, of course, a bullish sign for the US stock market. US dollar is strong, quite volatile over the last week or so. We see some big downward moves and some pretty good upward moves, so there's lots of uncertainty in the US dollar. I remain bullish, but a little bit cautious here because of that uncertainty. And really, we did break the upward trend line 3 days ago, but it's bounced back since then. So I want to keep a close eye on this because it does have a big effect on the US stock market. If we see the US dollar roll over, it's going to help commodities, going to help stocks even more. Here is the chart of the gold ETF, GLD, in a downward trend, rallying over the last week or so, but we expected that because the market for gold had fallen away from its downward trend line so far. So I think we could see gold rally up a little bit farther on the ETF up to that 158 mark, but I don't see any signs yet that it's going to break that downward trend. Probably goes up a couple bucks and then falls down again, and will trade between 152 and 158 with a downward bias in the near term. Here's the chart of oil. It is in a sideways pennant pattern. We've seen this market just sort of grind this in this sideways pattern for some time. I'm going to call it a neutral chart. It's a neutral chart with a little bit of a negative bias because the trend into this pennant was down. But I think we're just going to grind sideways here. However, that doesn't mean that some of the energy stocks can't do well. We're starting to see a resurgence in the energy stocks. The US energy stocks moved first, and now the Canadian market on the energy side is starting to catch up. So that's encouraging. Even though the commodity isn't doing all that great, the prices of the energy stocks are starting to improve. Now, we had a little bit of an uptick in fear in the last couple of days with the issues going on in Cyprus, but the trend in fear remains down, and until we get a break from a rising bottom, we don't need to get too excited about the market collapsing. Now, when we look at downtrends, we also can look at speed bumps and cliffs as well, and we've had some speed bumps in this downtrend, but no reversal where we're getting a break from a rising bottom. All right, so I remain bullish on US stocks. On Canadian stocks, I'm now bullish, although we still haven't made that strong break through resistance, but I think it could happen soon. So let's call it optimistic on the Canadian market. Gold, I remain bearish, although I do expect a little bit more short-term strength before it rolls over. Oil, I'm neutral, but like I said, some of the energy sectors are looking pretty good. Thus far, recent selling pressures in US stocks is just a speed bump caused by European uncertainty. Until there is a trend line break, stay bullish. The Canadian market is improving, while gold's bounce may soon end and the downtrend resume. Well, that has been the Stockscores Market Minutes. I encourage you to subscribe to this YouTube channel, and that way you will get instant updates anytime I upload a new video. Have a great week in the market and trade well.